Welcome to The Explainer. Today, we're diving into a huge question for any business. How do you turn a great idea into a billion-dollar reality? Well, we're going to unlock the financial toolkit every strategist needs to do just that.
It's just a perfect way to capture a core business truth. A brilliant strategy is totally useless if you can't actually execute the play.
And that, right there, is the central challenge for any company with big dreams. Execution costs money, sometimes a lot of it. So, where does that money actually come from?
Okay, so here's our game plan for today. We're going to tackle that big question, and then we'll break down 3 really powerful financial tools that strategists use to get the right answer.
First up, we've got to frame the fundamental challenge itself. How in the world do you get the cash you need to turn a recommendation on a PowerPoint slide into a real market-changing product or service?
Well, this leads to the first major decision, and it's kind of like a fork in the road. Do you take on debt? That means you borrow money, you have to pay it back with interest, but hey, you keep full ownership. Or do you issue stock? That means selling off a piece of the company, you get the cash, but your own stake gets diluted. So how do companies choose? You know, they don't just flip a coin. They use this really powerful data-driven tool called an EPS/EBIT analysis to figure out the smartest path forward.
This analysis follows a really clear 4-step process. You gather all your data, you set up a table comparing the different options, you crunch the numbers to project your earnings per share, or EPS, and then you graph it all out. The whole point is to find out which financing option, debt, stock, or some mix, is going to create the most value for shareholders.
Now, let's make this real. Here's a look at Procter Gamble needing to raise $5 billion. And what's so interesting is how the best choice totally flips depending on the forecast. If they think earnings might be low, the pessimistic case, issuing stock is the winner. But if they're optimistic about big profits, taking on debt actually gives the best return to shareholders. Okay, so let's say the decision is made. The company knows how it's going to raise the money. The next critical question becomes, what's the business going to look like after they've spent all that cash? Well, the tool for that job is called projected financial statements. And you can honestly think of them like a financial time machine. They let you build out what the company's income statements and balance sheets could look like a few years down the road, showing you the future impact of your strategy. Now, the crucial piece that makes this whole thing work is this simple little formula. You take the company's profit, its net income, subtract any dividends paid out to shareholders, and whatever is left over gets added to retained earnings on the balance sheet. That's it. That's the engine that grows the company's value over time. All right, the last tool in our strategist toolkit is all about valuation. This answers that absolutely vital question that comes up all the time in mergers, acquisitions, or even just for knowing your own position in the market. What is this business actually worth? You know, putting a price tag on a massive company is definitely part art and part science. But strategists typically lean on these 4 main methods to come up with a number, and each one looks at the company through a slightly different financial lens. So this is where it gets really wild. Just look at the insane difference in P&G's valuation depending on the method you use. It goes from over $240 billion all the way down to a negative $13 billion. So wait, how can a giant like P&G possibly be worth less than zero? The answer is all in the accounting. See, the net worth method takes the company's value on the books and then subtracts all the intangible assets, things like brand names, patents, reputation, all the stuff that's lumped together as goodwill. For a company like P&G, whose value is almost entirely tied up in its famous brands, subtracting that goodwill leaves you with that shocking negative number. So when you put this all together, these 3 tools, the EPS/EBIT analysis, the projected statements, and the valuation methods, they really form the analytical mind of a strategy. They give you that logical, numbers-based foundation you need to make smart, defensible decisions. But, and this is a really big but, the numbers are only half the story. As the legendary strategist Dimon from JPMorgan Chase points out, success really has more to do with heart than mind. It's about the people, the collaboration, the culture that actually brings that financial plan to life.
And that leaves us with a final thought to chew on. If a great strategy really needs both a sharp analytical mind and a passionate collaborative heart, which one do you think, at the end of the day, is more critical for success? The perfect financial plan or the perfect team to execute it?